Good morning. Welcome to America First Wealth Management Investment Outlook for Monday, February 24th, 2025. My name is Dan Lew. I'm the Chief Investment Officer and Portfolio Manager at America First. Turning to our standard disclaimer, we're not offering any investment advice or recommendations to purchase or sell any securities. And these opinions are expressed as of February 24th and are subject to change without notice. So we like to begin by discussing our market outlook and provide supporting information after this, so our viewers can get the gist of our recommendations and summary. In terms of the market highlights for last week, we saw a weaker U.S. stock market, largely driven by consumer spending and supply chain concerns, and we saw that manifested in a steep drop in Walmart prices after they reported earnings. In fact, I believe it was one of the largest weekly drops in Walmart since about 2022. European stocks also ended mixed with trade and local rate cut concerns. However, turning to Asian markets, they were up 6 weeks in a row now. Treasury yields dropped after Friday's economic data and investors' flight to safety. This morning, we wanted to talk about some warning signs that we are seeing and noting, especially over the weekend. Berkshire Hathaway provided their annual shareholder letter, authored by Warren Buffett, and we do note that there are record cash levels at Berkshire Hathaway. We'll talk more about that later. We did point that out previously, but the annual report highlighted even larger cash builds. We also noted late last week that there was a report out that Microsoft canceled some data center leases, and that's causing some concern among the AI stocks. And we also saw some inflation forecasts that were increasing that are troublesome. And the key signal we're looking forward to this week is NVIDIA reporting earnings on Wednesday after the close. And certainly many headlines with respect to the Trump administration and Doge. We call this the Trump and Doge factors, and we can summarize it with one word: pressure. Pressure on Ukraine, pressure on federal agencies and employees, pressure on U.S. trading partners, and pressure on NATO. We can also call this pain before gain, and that seems to be the hallmark of the Trump administration strategy to focus primarily on America and trying to fix some of the spending concerns that are out there. So he's in a hurry to do that. Obviously, it's being met with a lot of debate and discussion. Some people love it, some people hate it. But this is what Americans have voted for, so we're certainly getting it in spades here. So turning to some of the data points we picked up, this is a Cowen report that they had looked at channel checks and U.S. data center leases, and they noted some significant cancellations by Microsoft, which does lead us to some concerns that there is perhaps an oversupply of AI data centers relative to the demand. So this is certainly a warning sign. It's not surprising given some of the signals we've seen recently, in particular China's DeepSeek announcement in terms of AI models being generated at a faster and cheaper rate than the current methodologies. So these efficiencies are likely to translate into potential lesser demand for data centers. So seeing this manifest itself in the lease cancellation, while certainly no surprise, it does lead us to concern about overall optimistic demand for AI data centers and AI hardware and networking demand. Turning to the Berkshire Hathaway record cash pile, it's 334 billion. This chart puts it in perspective. This is the largest cash pile that Berkshire Hathaway has held in its entire history. Surprisingly, Warren Buffett now holds $91.1 billion, more treasury bills than the Fed. That's how dramatic that increase is. So it begs the question, what is Warren Buffett worried about? Well, probably not much, being that he's $94 billion, and I think the sixth wealthiest person on the planet, but he's always been concerned about value. Berkshire Hathaway has not repurchased any of its shares in the last 2 quarters, which is a signal that it views its own stock as being overvalued, even with respect to the amount of cash that it's holding. So I think Warren and his investment team are patient and willing to wait for better values to emerge, which are likely to happen after some sort of a correction. Because given the current political and economic environment, it doesn't seem likely that earnings growth are going to accelerate at this juncture. Turning to an inflation forecast that we saw, it was a little troubling. This is some work that was put out by Bank of America. They noted that CPI inflation has averaged 0.4% month over month during the last 3 months. And what they did here was just projected out that 0.4% month over month average over the next 6 months, which would translate into a 4.6% year-over-year inflation rate by July. And then this chart also shows lower averages 0.3, 0.2, 0.1% month over month, and showing those projections. So even in the most optimistic case, if inflation averaged 0.1% month over month for the next 6 months, core inflation would still be 2.2% year over year, which is slightly above the Fed's target rate of 2%. So I think more realistically, we're going to see a 3% year over year inflation, 3% plus, given these numbers, unless there's a significant fall off in demand by the economy, and a fall off in demand would obviously lead to a drop in inflation, but that's an unlikely forecast given the current economic scenario, in our opinion. And turning to NVIDIA's earnings report expected this Wednesday after the close. Barron's headline summarizes it. Its earnings could make or break the market, and we're certainly in agreement with that, given the lofty valuations for many of the AI stocks in the market. And we highlight this chart again for the third week. This is the average S&P 500 monthly return since 1928. And February historically has tended to be the second worst month of the year, and we continue to be in agreement with that and will not waver from the historical averages. And turning to the weekly market stats, you can see the month-to-date returns for the Dow Jones and S&P 500 now in the red. Only the NASDAQ and NASDAQ 100, which are more tech-centric, being green. Small caps are down, as indicated by the Russell 2000, down 4% month to date. Large growth is down. Large value is faring better, but still also in the red. International stocks are marking a positive gain, up 2.9% month to date. Investors are finding shelter in bonds. The iShares Core US Bond ETF is up just under 1% month to date. So Our assessment of these numbers is that investors are looking for a pause, looking for some safety and diversification, both in international stocks and in bonds. And once again, turning to the Magnificent Seven, you can see a lot of red on the 1 week and the month to date, as also on the year to date. Now there's only two names in the Magnificent Seven that are positive in the Magnificent Seven. So it's a complete reversal from the prior 2 years. The Magnificent Seven names, in our opinion, are no longer leading. And investors should take note that diversification and keeping some dry powder is probably um, a good position to be in, given the strong runs in the growthy momentum names during the last 2 years. U.S. sector performance also reflects flight to safety, with consumer staples and utilities being the top two performing sectors week to date, followed by healthcare. So these are all defensive sectors in the top three. And you can see the more economic sensitive and growth sectors, consumer discretionary, consumers, communication services, and tech being at the bottom performers for the week. For the year to date, though, most sectors are still positive except for consumer discretionary. And it's kind of in our opinion, a kind of a textbook performance for February so far. We'll have to get through the additional data points during the last week of this month and hopefully moving towards a better situation into March. S&P 500 index year for the 1 year period chart here, which we would continue to show. The dotted red is the 10-day moving average, which has been a good indicator for us. We've now shifted into a more of a bearish stance for the S&P 500, with that trading below the 10-day moving average. The RSI is about tending towards the middle of the range, not slightly oversold, but not pointing towards a buy point for the RSI. Long-term trend is still upwards, which is positive, but the short-term decline is, in our opinion, probably healthy, but obviously some short-term pain for investors who bought near the tops. We do advise that investors continue to keep some dry powder, wait for better entry opportunities. Turning to the 10-year Treasury yield, this is in contrast to stocks, trading below the 10-day moving average, which is flashing a bullish sign for interest rates as we see a flight to safety. 10-year Treasury yield ended the prior week at 4.42, down 5 basis points. And year to date now, down 16 basis points. Still relatively high. We'd like to see continued improvement in yields before we can get bullish on areas like real estate. But certainly noted to have a nice effect in some of the defensive stocks, particularly in utilities, as we mentioned, and consumer staples and healthcare. Turning to the yield curve, we do see the prior week ending in blue, a clear drop in yields, pretty much at the longer end from 2 years and out. We see a drop in interest rates. On the short end, though, still relatively high, which does argue which does argue for a rational investment in cash and treasury bills, being that you're getting higher yields in treasury bills than going out to the 3 and 5 year period. But at about the 10-year mark, it becomes more favorable to be invested in longer term bonds, provided that you're comfortable with the higher volatility that longer term bonds have. But for the most part, the risk reward does tend to favor being at the short end of the curve, in our opinion. Turning to economic calendar, not a lot of huge events for the week. We've got manufacturing, Dallas Fed manufacturing, and Chicago Fed activity today on Monday. We've got the Case-Shiller home price index tomorrow, a couple of Fed speeches going on Tuesday. Pretty much the same information, standard information on Wednesday. Like we said, the Wednesday NVIDIA report after the close will be the key data point on Wednesday for us. Thursday, we'll probably be dealing with the aftermath of the NVIDIA earnings results and outlook. We do have some durable goods orders and GDP growth rate Thursday morning. A couple of Fed speeches as well. Going on to Friday, we've got the core PCE and personal income. Those would be two important macro data points on Friday. S&P 500 earnings, just flipping through this quickly. We do have Domino's Pizza that reported this morning before the open. They had a miss, both earnings and revenues, so that's trading down. After the close, we have a couple of energy companies, REIT companies. Tuesday, I'm going to go through these in particular. Home Depot is an important name reporting before the open. Wednesday, Lowe's following up on the Home Depot numbers. Got TJX, which is another bellwether retailer that's reporting during market hours. After close, as we mentioned, the video will be the key one. We will also have Salesforce, eBay. Those will be important names reporting. Thursday, we do have Dell, Autodesk, NetApp. And that's pretty much it for the week. So this is a week we do recommend investors maintain some dry powder and be cautious. Let's wait for NVIDIA's report and additional signals that markets are in a better entry point. And this may take a few weeks before we get to that point. In the meantime, thanks everyone for tuning in. And if anyone would like to reach out to us, please contact myself or Jim. Our emails are listed below. Thank you for tuning in, and we'll talk to you again next week. Have a good day.